Janard Trust here. In this video, I'm going to discuss a complete guide to accounting. Now, let's talk about core financial statements. Profit and loss, right? Statement, right? Shows profitability over a specific period, whether it's monthly or yearly. It details income, cost of goods sold, gross profit, expenses, and net profit, helping assess tax obligations and financial performance. The income statement, right? Synonymous with the P&L statement. It summarizes revenues and expenses to determine net income or loss, combined with cash flow and balance sheets. It provides a holistic view of financial health. Cash flow statement tracks cash inflows/outflows across operations, investing and financing activities. It highlights liquidity management and tax payments like the VAT, corporation tax, etc. The balance sheet is a snapshot of a company's net worth at a given time, listing assets, liabilities, and equity. It complements cash flow and income statements to reveal financial obligations and resources. Bank reconciliation, so it compares internal records with bank statements to detect discrepancies, prevent fraud, and categorize transactions for accurate reporting. We have foundational accounting principles. That's the consistency principle, right? That mandates uniform reporting methods across periods to enable reliable comparisons. Changes in procedures must be disclosed. There's the sincerity principle, which ensures financial data is presented honestly and accurately, free from intentional misrepresentation. There's the principle of regularity, which requires adherence to standardized accounting rules like the GAAP for fairness and comparability. The continuity principle assumes the business will operate indefinitely, valuing assets based on current operations rather than speculative future plans. The accrual basis accounting records revenue/expenses when incurred, not when cash exchanges hands. Contrast with cash basis accounting, which recognize transactions upon payment. Now, the key accounting concepts is the double entry system. Every transaction affects at least two accounts, debits and credits, maintaining the accounting equation. So assets equal liabilities plus equity as sets equals liabilities plus equity, right? So let me say that one more time. Assets are liabilities plus equity as, sets equals liabilities plus equity. The GAAP, Generally Accepted Accounting Principles, standard guidelines for financial reporting, ensuring consistency and transparency. We have the chart of accounts, the COA, which is a categorized list of accounts, assets, liabilities, equity, revenue, and expenses used to organize transactions in the general ledger. We have the fiscal year, a 12-month reporting period, which may align with the calendar year or a custom time frame. Accounts payable/receivable. Payable, money owed to suppliers/creditors, which is the liability. Receivable is the money owed by customers, the asset. The accounting cycle is the number one, identify transactions, recognize financial events, which is sales, purchases. Two is journal entries, record transactions using, debits or credits. Three is post to ledger, so transfer entries to the general ledger. Four is trial balance, so verify total debits equal credits. Five is adjusting entries, so update accounts for accruals/prepayments. Six is financial statements, right? Prepare the P&L, the balance sheet, and cash flow statements. Seven is closing entries, so reset temporary accounts like the revenue/expenses for the next period. The essential terminology is we have working capital, which is the current assets minus current liabilities. Equity capital is funds from investors in exchange for ownership. CPA is certified public accountant, so licensed professional offering audit, tax, and advisory services. So this guide combines theoretical principles with practical tools, equipping beginners to navigate financial reporting, compliance, and decision making. Now, balance sheet is incredibly important. How do you create one? You can by choosing your tool, whether it's a spreadsheet, Excel, or Google Sheets, which offers customization for manual entry. Accounting software, you have QuickBooks, for example, which automates calculations using existing transactional data. Two is set up the structure for spreadsheets so you can create columns. Column A is account category, whether it's assets, liabilities, equity. Column B is account name, like the cash or accounts payable. Column C is the balance amount, right? Then you're gonna have to label sections, right? Like the assets, be it current, cash, inventory, non-current, equipment. Liabilities, the current is the short-term loans, non-current is the long-term debt. Equity is owner's capital, retained earnings. Populate asset accounts, like the current assets are cash, accounts receivable, inventory, which is ordered by liquidity. Non-current assets is property, equipment, intellectual property. Total assets, you can use the sum range formula to calculate. You can list liability accounts like current liabilities, accounts payable, short-term debt, non-current liabilities like long-term loans, deferred tax. Total liabilities, you can sum up all liabilities. Calculate equity, like the owner's equity equals total assets minus total liabilities. Include retained earnings and investor contributions. So verify the accounting equation. So ensure assets equals liabilities plus equity. So using accounting software, navigate to reports, select balance sheet in QuickBooks, right? For example, set the date. So choose a snapshot date like December 31st, 2020, whatever. Generate the report. So software autofills data from ledger entries, export, save a PDF/Excel for stakeholders. Now, here are some best practices in that regard. So update regularly, whether it's quarterly or yearly. Reconcile with bank statements to ensure accuracy. Use templates for consistency, right? Now, here are the main differences between financial accounting and managerial accounting. In regards to purpose and audience, financial accounting focuses on external stakeholders, investors, regulators, creditors by producing standardized reports like income statements and balance sheets. Managerial accounting serves internal decision makers like the managers, executives, etc. with operational insights, forecasts, and performance analysis. The reporting standards, financial accounting, it's mandated to follow the GAAP/IFRS for consistency and compliance. Managerial accounting, no regulatory standards, tailored to internal needs and strategic goals. Time orientation for financial accounting is historical focus, summarizing past performance, like quarterly or, annual reports. Managerial accounting is for future oriented, emphasizing forecasts, budgets, and scenario, planning. Report frequency and detail. So financial accounting is the periodic, monthly, quarterly, yearly, aggregated, and concise. Managerial accounting is continuous or on demand with granular details, product, line profitability, cost, or cost drivers. So that's what I have here today. Please take a moment right now to hit that subscribe button and the like button. If you gain value from the video and you want more videos like this, please let me know by hitting that subscribe button and the like button right now. I appreciate your viewership. See you on the next video.